Welcome back to Coalition Conversations, where we bring you inside discussions from CPA staff and our members. I'm your host, Melissa Tallman. Today, we'll be discussing sales factor apportionment, SFA. Apportionment formulas are designed to allocate to a taxing state, for tax purposes, a share of a company's income that corresponds to its business activity in that state. My guest today is David Morse, Tax Policy Director for CPA, whose recent opinion article can be read in Inside Sources, says the answer is to tax foreign multinational corporations based on their sales in the United States. If a company generates $1 billion worth of profit on its U.S. sales, then it should pay corporate taxes on that $1 billion. David, welcome. Thanks for joining me.
Thank you.
We've discussed SFA prior here on Coalition Conversations, and there's been some recent buzz lately on some great progress to adapt to a SFA system. And I think most Americans would agree with you that the fact that the multinational firms are able to sell products in the U.S. market and then pay little or no federal taxes on the resulting profits is unfair. Can you give us a brief update and what we need to know now?
I'd be happy to. So sales factor apportionment has finally made an introduction on the global stage and in the national media. However, I'm afraid the story on where the corporate tax avoidance solutions overall, that gets a little more complicated. So let's start with sales factor apportionment. To be clear, no one has officially suggested implementing a plan called sales factor apportionment. It's just not there. But the Financial Times did leak a Department of Treasury offer to the OECD negotiators from other countries to clean up their international tax proposal called Pillar 1. Now, Pillar 1 is part of this two-pillar system at these international level negotiations. Pillar 1 reallocates profits from corporations based on a market jurisdiction, regardless of permanent establishment. So let's put that in simpler terms. Pillar 1 allows countries to tax the corporate profits based on the sales in the country, regardless of where they have a physical presence. That's a big change from where things are normally, and these are the core precepts of sales factor apportionment. Now, previously, Europe and the emerging markets, they had tailored this Pillar 1 to digital companies and consumer-facing businesses and there was dispute about what that meant. But they also created a number of carve-outs and decimated those core principles in favor of, I'd call it a toothless mechanism for every other type of company except U.S. digital companies. The U.S. Treasury is suggesting a simpler system with a very, very high threshold of revenue. I believe the first suggestion was $20 billion in revenue, and a required level of profitability before Pillar 1 would apply to the company. And right now, the proposal is aimed at the top 100 corporations in the world, regardless of their industry. This required returning to the core arguments of ignoring physical presence and focusing on economic sales. Admittedly, other countries are currently parsing through this offer.
Interesting. So does this proposal appear in any domestic legislation?
No, and that's something that we have to be clear about. On the domestic front, the White House's big push for a number of tax proposals to pay for their infrastructure spending does not address this issue. The infrastructure spending package, known as the American Jobs Plan, and the way to pay for it is known as the Made in America taxes. Made in America taxes, there are about 7 proposals, and half of them deal with international profit shifting and just overall how much do the corporations actually pay. And so none of them are using sales factor apportionment. They're all revolving around altering the Tax Cut and Jobs Act that was passed in 2017. So the first thing that they plan to do is there's this global minimum tax that the U.S. has implemented known as GILTI. And what it does is it reduces 50% of the deductions that are associated with a U.S. corporation's offshore profits. So these are American parent companies, but they have their profits that are being made by their overseas subsidiary. And right now it's a 50% deduction on that money coming back in. What the administration is proposing doing is turning that into a 25% deduction, but combined with their ideas about raising the corporate tax rate ultimately they say instead of paying 10.5% on those profits from overseas, you'll pay 21%. Furthermore, the White House intends to remove a carve-out that exists. It's built for the concept of routine profits. So there's been this artificial designation as to what is a normal, regular profit that a corporation can expect, and those are called routine. And right now, there is an exemption for those routine profits at about 10% of a corporation's overseas investments, but only the ones that belong to their subsidiaries. And it has to fit certain IRS definitions. So basically, there's this carve-out out there that reduces how this entire complicated system works even more. And they're trying to get rid of that to simplify it. Another change is they're replacing the measurements that surround the tax rules for any corporation that use royalties, interest, insurance, other costs that move overseas. And the current law to address those particular types of profits are known as BEAT, Border Erosion Anti-Abuse Tax. Now, these BEAT deductions are, right now, it only applies in extreme circumstances, but the administration wants to scrap it entirely because they feel it has failed. And they want to replace it with a new plan called SHIELD. And it's another big, long acronym. But basically, the new plan will, instead of allowing those deductions to be taxed whenever they are decided that profit shifting is occurring, instead, they expect the subsidiaries of the companies, so these overseas subsidiaries, they have to pay at least a minimum tax to their home country. If they're not doing that, we will deny them those corporate deductions. So it's not just a small recapture. It is an absolute, you don't get it at any point whatsoever because you're sending profits to a company that's not paying at least the minimum. Finally, the administration is talking about ending the Tax Cut and Jobs Act, FDII, otherwise known as FDII, altogether. Now, FDII is a carrot reward for intellectual property that gets allocated to the United States and then sold overseas. So we're talking software, trademarks, and the Biden administration believes that they can make it better in a different form by giving that money to R&D. So I would say that these provisions are all related because they all have to do with Pillar 2, but none of them have to do with what we're hoping for, which is sales factor apportionment on Pillar 1.
Okay, I'm trying to wrap my head around this because it just sounds complex. But why is the administration keeping the previous system if it is this complicated?
Well, I would have to say I think the administration is entertaining the art of the possible. They're hoping it's easier to understand the idea of tweaking and changing the Tax Cut and Jobs Act than to embrace an entirely new system. Now, no one has forgotten back in 2017, before the Tax Cuts and Jobs Act, that there was this proposal for a cash flow tax. But what the cash flow tax effort ended up doing is it ended up, one, getting a lot of retailers mad at Congress, so they had to scrap it. And ultimately, it was decided that it was just too risky to take that road. So I think the administration's worried about taking a completely new approach. That being said, what the cash flow tax did accomplish was it clarified that the previous tax system, where we had this old system of a corporation could keep its profits offshore indefinitely and never have to pay taxes on those profits, that system had awful incentives to offshore, and that recognition led to the creation of GILTI, BEAT, and FDII, which were genuine attempts to combat those problems. I'd say the TCJA helped inspire the international community to look at the problem of offshoring and has set the stage for where we are today.
So do you think, do you think that the TCJA succeeded or failed?
I would say it's complicated, but you have to recognize that the TCJA did stop major inversions and did raise some revenue through GILTI provisions. You can't deny that. However, the immediate revenue track record of BEAT and FDII suggests those programs have failed to live up to their promise. In the tax world, it's often suggested that businesses must be patient and you have to wait, 3 to 5 years to see if a tax policy was really effective or not. And many times, if it's not effective, then they say, oh, there was this unrelated external factor that led to it being unaccounted for. The reality is domestic businesses can't wait 3 to 5 years at this point. They need this system that works for them yesterday. Honestly, that's one of the reasons that I still think sales factor is better, because nothing has changed in the dynamic that shows that domestic companies still have to worry that they pay a higher percentage of taxes than the multinational companies that can offshore. The TCJA did not accomplish that goal of ending that tax disparity. It made a dent, but didn't end that. Now, the Biden domestic proposals take a complicated means to try to achieve the result more directly. But the jury is still out on whether or not it will be enough. But I have to say, since Treasury's international offer on Pillar 1 plants that seed for genuine reform. So if the OECD succeeds, I'd say Congress will need to pass legislation to codify the agreement. Now, that will be most likely through a treaty and subsequent legislation, because this has to do with taxes, and the House will have to be involved there. But if the OECD negotiations fail, Congress still has an example. They have an example to follow of this market allocation of profits regardless of physical presence. And that's a tempting target to implement unilaterally, because it's attractive to Republicans because it's territorial and would hold digital companies' taxes accountable. It is attractive to Democrats because it raises a significant amount of revenue. It's attractive to nearly everyone else who's not really thinking along those lines, because it's pro-small business tax reform that simplifies the tax code and puts everybody on an even playing field. But for now, I think we just have to wait and see what the future holds. The administration has yet to reveal their full negotiations to Congress, and I would say tough questions do lie ahead for them.
We still have a long way to go, but David, thank you so much for explaining a little bit more on SFA and giving us some updates. If you'd like to reach out to David, you can feel free to email him at david@prosperousamerica.org. If you've enjoyed this conversation, please give us a thumbs up and be sure to subscribe to our YouTube channel. If you could share this video, together, let's keep America prosperous.